today we're diving into the newly passed One Big Beautiful Bill, a sweeping law that could change and reshape how you think about taxes, estate planning, cash flow, and investments. I'm Steve Boorstein. I'm joined by my colleague and son, Aiden, and we're both financial planners here at RockCrest Financial. Today's episode is all about unpacking this massive new law in plain English.
That's right. This bill is 870 pages long, touching everything from defense spending to estate taxes, and it's got something for just about every taxpayer. It was signed into law on July 4th, 2025, and it permanently enacts many of the 2017 TCJA, or the Tax Cuts and Jobs Act provisions, with a few powerful additions. Before we jump into this, please leave a like and subscribe to support our channel and see more videos on personal finance.
So let's start with the tax side. First, individual income tax brackets, ranging from 10 to 37%, are now permanent. These lower brackets were set to expire, but they're now locked in going forward. And that includes a larger standard deduction, now $15,750 for singles and $31,500 for joint filers, and permanent elimination of personal exemptions. There's also an expanded child tax credit, which is increased to $2,200 per child.
And if you're 65 or older, you now qualify for a new senior bonus deduction. This is $6,000 extra for singles and $12,000 if you're married couples filing jointly. That's likely to make Social Security benefits tax-free for about 88% of retirees, although technically Social Security isn't completely tax-free under this bill.
So we're also seeing some new above-the-line deductions, including up to $1,000 for cash charitable gifts, $2,000 if married. These are gifts to public charities and don't include private foundations or donor-advised funds. So even if you're not itemizing, you can still take this above-the-line deduction. Speaking of charitable giving, also got a lot trickier. Starting in 2026, deductions only count above the 0.5% of AGI mark. High-income donors are capped at 35 cents tax break per dollar donated, down from 37 cents if you were in the top tax bracket prior to this bill. You may want to accelerate big gifts in 2025 or use a donor-advised fund to lock in higher deduction value, depending on your situation. Now, there's also a new deduction for certain overtime wages and tips. Eligible workers can deduct up to $25,000 in tips, and this is qualifying occupations, from their taxable income, and up to $12,500 in overtime pay through 2028. These deductions begin to phase out for individuals earning more than $150,000 annually, $300,000 for joint filers. And here's a surprise one. Auto loan interest is now deductible. In order to be eligible for this deduction, the interest paid on the loans are for new vehicles only. The vehicle must be assembled in the U.S. and used for personal purposes. The deduction is temporary and it's available from 2025 through 2028 tax years. The maximum deduction is $10,000 in interest per taxpayer a year, and the deduction begins phasing out for individuals with adjusted gross incomes of $100,000 and for married couples filing jointly with incomes of $200,000. The deduction does not apply to RVs and campers, ATVs, or trailers.
One of the biggest planning changes, the SALT cap deduction, previously stuck at $10,000, is now quadrupled to $40,000 for individuals and up to $80,000 for married couples from 2025 through 2029. So if you live in a high tax state like New York, New Jersey, or California, this could mean thousands in added deductions. For example, if a New Jersey couple pays $30,000 in state and local taxes, they used to only deduct just $10,000. Now they can deduct the full $30,000, saving about $6,000 in federal taxes if they're in the 30% tax bracket.
But here's a heads up. So there's a phase out for high earners. Once your taxable income exceeds $500,000, that $40,000 cap shrinks quickly by 30% of the excess income. For example, if your income is $600,000, so you're $100,000 over that $500,000 mark, your SALT deduction might drop back to $10,000, erasing $30,000 in deductions. So smart bracket management is critical. So think about things like deferring income, accelerating deductions, charitable bunching of deductions, or even non-grant trust strategies.
There's also great news for small business owners and real estate investors. The QBI deduction is now permanent at 20%, so business owners and some real estate investors can count on that 20% cut. For instance, if you have $200,000 of qualifying business profit, you can deduct up to $40,000 from taxable income.
So also there's another big one. 100% bonus depreciation is back and made permanent. This lets businesses immediately deduct the full cost of new equipment and machinery. So if a small business manufacturer buys $100,000 of new machines in 2025, they can write off all $100,000 in 1 year. That frees up a lot of cash flow. by lowering taxes now. So it's an incentive to invest in growth, and similarly, domestic R&D expenses can be deducted immediately. Companies can now expense all qualified research costs instead of amortizing them. So for investors, this means startups and tech firms will have better cash flow to reinvest.
There were also some great additions for investors and families. 529 plans now cover elementary, secondary, and vocational education. This gives an even bigger benefit to using this type of education savings plan over something like a Coverdell ESA. Also, HSA contribution limits are expanded and more people qualify. And yes, it's real, there's a new MAGA account or Trump account. Parents can contribute up to $5,000 per year, and the government will even deposit $1,000 for babies born during these years. Once the child turns 18, they can make withdrawals from this account without penalty when used for qualified purposes. And those distributions are treated as long-term capital gains. This is a very interesting planning opportunity and a good way to start investing early for your child, but also may not live up to the opportunities that 529s and Roths can provide for your kid. So beyond that $1,000 of free money, this may not always be the most optimal strategy.
Let's talk about a more advanced but powerful strategy, Qualified Opportunity Zones, or QOZs. These just became even more attractive under the new law. So here's what's changed. Capital gains invested into a QOZ fund now defer taxes until December 31st of 2028 instead of December 31st of 2026. If you hold a QOZ investment for 10 or more years, any gains from that QOZ itself are completely tax-free. And now there's bonus incentives for investments in high-impact zones, like green energy, affordable housing, distressed rural areas. These get extra tax perks. And there are some other benefits too, but the bottom line, QOZs are still one of the most powerful tools to defer and eliminate large capital gains, but these strategies require work. So planning is the key, and you also have to be an accredited investor.
The estate and gift tax exemption rises to $15 million per person in 2026, or $30 million per couple, which preserves a major planning opportunity that was about to sunset back to $7 million.
And just remember, 18 states still have their own estate and inheritance taxes, some with much lower exemptions, like $1 million or $2 million. So don't overlook that in your estate planning.
So what does this all mean for different income groups? According to early data, it looks like about 70% of households should benefit from this bill, and the bottom 30% of households may see a slight decrease in their after-tax income, but for the majority of Americans, this bill will actually improve their cash flow.
So just some final thoughts. There's a lot to the recent passage of this one big beautiful bill, and that means a lot of potential planning opportunities. If you have an advisor that's evaluating your situation and seeing which strategies work best for your planning, that's great. But if not, that's what we do for clients. So reach out to us for a consultation. This is how we help our clients. And if you like this video, please share it, like, and subscribe to our channel.